it doesn't eliminate the estate tax. So if you are a ultra high net worth individual, and or if you are worth more than basically 6 million single, 12 million married as of 2026, you're looking at a huge estate tax of 40% of anything that's above and beyond that. Hello, welcome to the top 5 ways to make the deferred sales trust an investment and not an expense. Let's dive right in. The number 1 way, if you are a business owner or investor who's selling a highly appreciated asset, to make the deferred sales trust an investment, not an expense, is to calculate your exact tax liability. How do you do that? Well, number 1, what's your sales price of the asset you're selling? Number 2, what is your adjusted basis? And essentially take the sales price minus any closing costs minus the adjusted basis. That's going to equal your gain. Now, depending on what state you're in, depending on the depreciation recapture, you can project or estimate approximately 25 to 50% of that gain is going to be taxed. So if you bought a property for $3 million and you're selling it for $4 million, you're looking at about $1 million gain on that. Let's say you're in California, you're looking probably around 37% minimum of that gain, which would be $370,000. So the first thing you want to do is figure out, well, how much can I make if I was able to defer that tax and roll it into the deferred sales trust and grow my wealth? So that's the first way to make the deferred sales trust an investment, not an expense. It's just the tax calculation. The number 2 way to make the deferred sales trust an investment, not an expense, has to do with the ability to reset a depreciation schedule or create a brand new depreciation schedule. This is so crucial because depreciation is an amazing way to offset cash flow, okay, to be able to essentially defer what you would have paid in tax by buying real property, typically also a business, but typically it's real property like a multifamily investment property, where the government and the IRS allows us to depreciate the property, the equipment, if you're a business owner, the lighting, the fixtures, the air conditioning units, and you're able to depreciate over time, and it's offsetting the cash flow while you're owning it. And so with the deferred sales trust, what's incredible is at first you're just a lender, you're lending the funds to the trust, and then immediately you can partner with the trust and become an owner of an LLC that the trust puts up the capital for as a silent joint venture partner, and you can purchase a piece of real estate of which it could have and will have a brand new depreciation schedule if you do it in this order. And now that depreciation can offset some of the cash flow, or a lot of the cash flow, if you do like accelerated depreciation. And so picture this, you sold stock, you sold a business that was fully depreciated, or a multifamily property that's fully depreciated, or even a primary home, and you deferred all of the capital gains tax and you turned around and you invested it into something that had a brand new depreciation schedule. Well, guess what? You just increased your ability to offset cash flow, which is incredible. Okay, so that is the number 2 reason to make and how to make the deferred sales trust an investment, not an expense. What is the number 3 reason to make or how to make the deferred sales an investment, not an expense? It has to do with paying off debt. You know, right now we're seeing adjustable rate mortgages happen where they're moving out of their adjustable rate or moving out of their fixed rate and going to adjustable. And so when this happens, guess what? You're in a place perhaps where if you sell and you were to have to do a 1031 exchange, you're going to have to stay in that debt or stay in more debt or stay in higher debt. And that's not great. In fact, we think right now is a great time to pay off debt. And the deferred sales trust allows you to make it an investment, not an expense, by allowing you to get free from that debt, not having to replace that debt like in a typical 1031 exchange. Or if you're selling a business, you can get free of that debt. And essentially what you receive is a promissory note for the net proceeds into the trust. Now, we got to be careful about mortgage over basis. If there's some debt over basis, we have a solution for that if you're selling investment property. You can check out another video on YouTube with one of my clients named Ron Anderson, where we go through how we solved that for his Airbnb property that he sold with his wife in the Denver, Colorado area. But that's a whole nother topic. But just realize that being able to pay off debt is a great way to de-risk where you're at currently with your holdings, which leads into the number 4 way to make the deferred sales trust an investment, not an expense, and that's buying at optimal timing with the investments in the trust and diversifying your wealth into perhaps even higher cash flowing producing assets. For example, in California, a lot of the assets have a very high appreciation, but the rents may not have caught up due to rent control. And so what's happening is you have a lower return on equity, which decreases your ability to grow the wealth if you are capped with rent control. Now, if you can unlock that wealth by selling and then diversifying into, let's say, multifamily syndications, or let's say into hard money lending, or let's say into the stock market with some, maybe some good prices where the market's down, you're able to start to create more wealth. And the key thing here is that optimal timing. So it's diversification tied with optimal timing that allows you to make the deferred sales trust an investment and not an expense as much, compared to just staying where you're at. And so that's the number 4 reason how to make the deferred sales an investment, not an expense. And what is the number 5 reason? It has to do with death tax. So you've heard the saying that 2 things are certain in life: death and taxes. Well, as a part of that, there's a thing called a death tax, or known as an estate tax, that if you're above a certain exclusion amounts, you're subject to very large 40% death tax. And the exclusions are about 24 million married now, 12 million single now, but in 2026, those are set to cut in half, maybe even lower, unless Congress changes something. But one of the biggest challenges, or one of the biggest myths with the 1031 exchange is, hey, just swap until you drop, and then you get a stepped up basis. That's true, but the rest of the story is it doesn't eliminate the estate tax. So if you are a ultra high net worth individual, and or if you are worth more than basically 6 million single, 12 million married as of 2026, you're looking at a huge estate tax of 40% of anything that's above and beyond that. Regardless of cap gains tax and regardless of a stepped up basis, it's a separate tax. Okay, so guess what? The deferred sales trust is an investment, not an expense, for number 5 reason, because we can eliminate that estate tax upon the sale of your asset, whether it's a C Corp, S Corp, LLC, whether it's a partnership deal, whether it's the business, cryptocurrency, stock, public or private, primary home, investment real estate. Upon the exit, we can eliminate that estate tax the way we structure what's called the Deferred Sales Trust Plus, or DST 2.0. It's an amazing way to make the deferred sales trust an investment and not an expense. Not only that, but upon the exit, and the assets are now inside of the trust, all of the growth is also outside the taxable estate. And so we recently helped a client with this who sold a large multifamily property in Colorado, and they were able to move it outside their taxable estate. Now all of that is growing estate tax free because it's outside the taxable estate, and it's growing estate tax free as well, which is pretty cool. All right, we'll give you actually one more bonus. This is a bonus one that I thought about during the research here. So with the deferred sales trust, the last bonus one is income tax deferral is a great way to make the deferred sales trust an investment, not an expense. Let me give you a story on this one. So we helped a client sell a high-end primary home in Palo Alto, and they had a high income and a lot of equity, and some equity, but a lot of debt on this property. But their main goal was to move to Nevada to be closer to family. And so we structured the payments on the trust to delay for a period of time until he established a residency in the new state of Nevada, which has no state income tax. And so the deferred sales trust became an investment, not an expense, because he was able to practice not only debt freedom, not only diversification, but also delay of that payment until he established a residency in a low tax state versus a higher tax state of California. This is also true for anyone who's in New York, New Jersey, or any other high tax states. If you're establishing residency, let's say in a Florida or Texas, or a lot of people are going to Tennessee these days. And so once you establish residency, the deferred sales trust is an investment, not an expense, because it can delay that income or that repayment to you until a future date. By the way, most deferred sales trusts are structured 10-year promissory notes, and these promissory notes are somewhere between 6 and 8% of earnings, net of fees. That is the goal. And the payments can be 5, 6, 7, 8. It could even be more. But the key is once you move into a new state, guess what? That's where the income, the interest income is taxed at ordinary income tax rates. If you are in that state, you get a little bit lower income. Now, the principal always follows, okay? So the nexus would be the New York, the New Jerseys, the California. So if you dip into principal, that's when you'll pay capital gains tax on that. So that's the top 5 reasons plus the bonus on how to make the deferred sales trust an investment, not an expense. Look, we would love the opportunity to help you out. We believe the biggest challenge with most people who are exiting is they don't have a clear plan and they haven't envisioned a clear future. And we want to help you with that as well, help you build a team of experts to help you execute on the deferred sales trust or other tax deferral strategies that might be a fit for you, like a cost segregation, like a 1031 exchange. It could even be donor advised funds. We are happy to work with you to see if it could be a great fit. Here's the key. You got to have $1 million net proceeds and $1 million gain. So if it's large enough on your exit, we would love the opportunity to talk with you at no cost, no obligation. One of my team members or myself, you can just go to capitalgainstaxsolutions.com. Thanks for watching this video, and we'll look forward to connecting with you real soon. Bye now.